Welcome. You're watching The Big Question. I'm Tamanna Inamdar. Once hailed as a rising star and stock market darling in India's clean energy space, Gensol Engineering is now back in the headlines for all the wrong reasons. What has happened with Gensol is a story of bold promises of a cleaner future, which has now descended into a murky tale of financial mismanagement and misused funds for personal extravagances. The latest blow came from SEBI, which has now barred promoter brothers Anmol Singh Jaggi and Puneet Singh Jaggi from directorships in the listed companies, stopped the company's planned stock split, and named a forensic auditor to investigate the matter. The regulatory action comes after a probe triggered by a complaint from June 2024 about share price manipulation and fund diversion. What SEBI has uncovered is some damning details. Backed by loans worth nearly 978 crores from government-run lenders like IREDA and PFC, the company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. 260 crores remains completely unaccounted for. The company has bought only some 4,700 EVs, which is fewer than promised. Not just that, funds meant for the project were funneled, allegedly, back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias, where the going price starts at 64 crores for a 4-bedroom, golf sets worth 26 lakh rupees, money transferred to accounts of wife and mother for personal use, money used to fund trips, payments of credit card bills, among others. Imagine that's not even the worst part. The company promoters have repeatedly lied to investors, and there are a whole lot of them. 36% of the free float of the Gensol stock is held by retail investors. They are left holding the bucket today. SEBI has noted that the company made misleading disclosures to investors filled with hollow MOUs. And when NSE officials visited their Pune plant earlier this month, what they found was shocking. Against the claim that the company has received large orders to build electric vehicles was a non-operational factory, no production, no staff, no minimal power usage, effectively indicating that there was nothing being done there. Based on this, SEBI has not minced its words, calling it a complete breakdown of corporate governance. It has also said that a listed company was being run like a proprietary firm. SEBI has accused that company funds were being used as if they were the promoters' piggy banks. Now, why has this shocked everyone? Gensol Engineering, of course, is a listed company that positioned itself as a key player in India's green energy transition. Its spectacular fall from grace has broader implications and lessons. The company has seen a market cap erosion of 6,890 crores since the second quarter of FY24. Its current market cap is just 490 crores, down from its peak of 7,380 crores. Share prices of the company have fallen over 80% from their high of 1,126 rupees. The Gensol episode has raised a series of tough questions on corporate governance, the regulator's role, credit agencies, etc. But the biggest one is, how did the promoters of Gensol Engineering get away with this scam for so long? To speak on this, I'm joined by Hetal Dalal, President of IIAS, Dr. Purva Javadekar, former member of RAC, SEBI, Pankaj Tibrewal, founder and CIO of Ikigai Asset Manager, and Suhail Nathani, Managing Partner at ELP Law. Welcome to all of you, and thank you so much for speaking with us today. Hetal, I'm going to begin by just getting your take. Now, I know this is an interim order. A forensic audit will follow, and probably if the requirement is there, it could go ahead with criminal charges. But as of today, investors watching this, and retail investors especially, what they're seeing for the Jaggi brothers is a slap on the wrist. They're barred from accessing capital markets. The stock split has been barred, and that's pretty much it.
Yeah, look, I think this is a very classic case in terms of what you typically see for companies which are not very well governed. I think when you look at the options for retail shareholders, they are limited. There is a legal action, of course, and they can 100 shareholders can get together, or 10%, or shareholders holding 10% can get together and either seek an operational mismanagement case or bring an EGM trial and remove the promoter. But by and large, at this stage, I think from the shareholders' perspective, they can only hope that SEBI is able to bring about a change in management. I think the issue from what the SEBI order seems to suggest is very clearly an orchestrated plan to divert money from the company into promoter controlled company for whatever be the reasons, including personal expenses and extravagant lifestyles. It's not a new story. And I think the fact that SEBI has come out with this interim order is indeed based on a complaint that investors have filed, is a starting point to some of the redressal to what has actually happened in the company. But I think at this stage it's too early to call on what the final action will be. Yes, the board, the promoters have been barred from being on the board and holding key MPs. It doesn't really stop them from remote control of the you controlling the company through remote controls. But notwithstanding, at this stage, it's still a step ahead than where it was earlier. And from the shareholders' perspective, they can only hope that SEBI takes a much stronger stance in its final order. This is an interim order.
Yeah.
In the final order,
No,
in
no,
their
of course.
measures.
What I think it's important for us to understand is the extent of fraud. Now, we have reached out to the promoters, and through this medium, I'm once again saying, come and speak to us if you have something to say, if you have a response to this, because there are two things. One is that, you are trying to run your company, you don't manage to. A lot of companies fail for a variety of reasons. That's one part of it. The other part is that you've gone out of your way to fool people. And that's where it gets shocking. I want your comment, Pankaj Tibrewal, on what this means from investor confidence point of view, because when the details come out, and I'm just quoting from the SEBI order, the promoters have diverted money to the mother, the wife, luxury flats, spent money on personal trips to the tune of 3 lakh rupees, shopped at Titan, bought golf clubs. I mean, it's a free-for-all that was going on here. Is there any other side of the story possible with the facts that we have right now?
So Tamanna, I think, as I've been saying across at different forums for the last 2 decades, investing is simple but not easy. And hence, corporate governance and forensic check becomes extremely important. We have a 11-point forensic framework. And if you look at the one most important thing which never lies over a period of time is cash flow. And we look at cash flow to EBITDA conversion. And generally over a 4-5 year period, if the cash flow conversion is below 70%, it's a red flag for us. And there are many other parameters like change in reserves, volatility in depreciation rates, auditors' remuneration in relation with the revenue growth rates, related party transaction, and so on and so forth. And we have given it as a part of our presentation, which is on our website, that what are the 11 forensic framework points which we go into. Also, in December, we wrote in our newsletter the IPO mania which was going around. And just to put numbers in perspective, so last year, 317 IPOs, total raise was 1,80,000 crores. And the average subscription was about 28-29x. An average listing gain was about 40%. So every investor thought that any company which is coming for IPO is a great company. But if you look at 2 important data points, which we have mentioned in our newsletter in December of last year, that if you look at over a more than a decade perspective, the companies start to pump up their revenue and their EBITDA and profit just before listing. So a couple of years before listing, you saw a very sharp curve of revenue and EBITDA and profitability going up, and cash flows being extremely weak. We see a huge amount of related party transactions before the IPO on the listing, before the listing. And after the listing, just the opposite happens, that the slowdown in revenue starts to happen, slowdown in profitability starts to reverse, and the real character of the company. And just to put numbers in perspective, over the last 22 years, only 51% of the IPOs listed on size of 50 crores and above have been able to outperform Nifty. And only 26% of the IPOs listed have been 5 baggers or more. So in the short term, IPOs look like a great thing, but don't forget they don't have a history. And I think history is extremely important because tigers don't change their stripe. And hence, we always advise caution that whenever you are investing in an IPO company, make sure that you do your proper ground check, forensic check, whatever data you have. And if not, stay away for a while, that let that company show and perform over the next 12, 18, 24 months, and then take an informed call. Because there are companies which will never change their stripes. And the company you are mentioning is one of them, where all kinds of corporate governance issues have evolved post the listing of the company. And people fell into the wrong narrative, and they're losing money. So it's an unfortunate part.
No, so two, three very important things pointed out here, and I'm going to come to you, Suhail Nathani. In terms of liability, of course, the promoters who are using public wealth, shareholder wealth, they have gone ahead and even forged documents from PFC and IREDA and given it to credit rating agencies saying, yes, we are paying loans when they're not paying back loans. So false information given to exchanges is a whole host of criminality. I'll ask you about that as well. But what about the enablers? What about the people who came out and said this is a good stock? Mr. Tibrewal spoke about doing forensic, investigations. How will a retail investor go to the factory and see that nothing is happening? I mean, NSE had to pull out Mahavitran electricity bills to come to this conclusion that nothing was being made there.
Sorry, Tamanna, is that for me?
Yes,
or?
Mr. Nathani, yes, sir.
Okay, so when you talk about enablers, corporate governance has a framework around it. Okay, so there were failures at many points. If you look at this company, it had a lot of independent directors.
Yes.
It had an auditor. And if this fraud was so egregious, and I'm using this in a possibility situation because this is an interim order and as lawyers, nothing's concluded until it's concluded. But assuming all this were to be true, the fact is that how can the auditor not know there's no factory in existence? These are very serious breaches and fundamental breaches going to the root of the enablers or the gatekeepers, independent directors, auditors. Then there's another situation here. The other situation here is that these are the most fundamental of quote unquote fraudulent transactions. It's directly gaining in the hands of the promoters. So, sending the money into the wife's account or the mother's account. Something is definitely amiss. This is a pattern, and unfortunately, that repeats itself often times in this kind of fraud. But the data available seems to suggest that something else was occurring. And the point you make about forging papers, once you go down a slippery slope, then you do anything to save yourself. So when they were asking about the loan payment, so if you see the SEBI order, there's a table on what loans were delayed and whatever else. Rather than giving that information, they forged a comfort letter from the lenders to say the account isn't. So once you're down that slippery slope, you're going to grab any rope you can. And I think this is a tragic case of very poor corporate governance. And there are several consequences. One, of course, SEBI has acted in a timely manner and has acted in limits of its power. Two, there will be criminal consequences, there will be auditor questions, there will be a whole bunch of questions that come out of this. And unfortunately, it is going to take time. And this is what will hurt investors because until all this is settled, value of the company is going to be affected.
The slippery slope is at one end, and of course, kudos to SEBI for coming out and investigating all of this. The company in question, it's a listed company, the stock is still trading, has not even come out with one word of explanation. Dr. Apurva Javadekar, give us your perspective of what is the extent of liability. For now, the promoters have been asked not to participate in stock markets or hold any key positions, and that's pretty much it. But how far and to what extent can any punitive action go?
So thanks for having me on the show. Just a disclaimer, I'm speaking in my personal capacity
Yes.
or not in connection with any work done for SEBI in the past.
Yes.
Having said this, I think the charges that can be brought by SEBI are limited. Well, SEBI is a over, I mean, like it's a regulator for listing listed companies. I think if the charges are of criminal nature, that can be brought under by different different departments like SFIO, serious fraud investigation, and so on and so forth. I strongly feel that in this case, if the data that is out there is has any merit or truth, then I think all those uh, agencies will be involved sooner or later after SEBI sort of comes up with a final order. SEBI has already in the interim order barred them from participating in the securities market, but I think they can also sort of make credit rating agencies answerable to some extent because I mean in this case really internal governance is one thing, but there are at least four external agencies that are involved: auditors, the lenders and their due diligence committees, the credit rating agencies themselves, and there were ample signals even before SEBI sort of came up with the interim order that things are not in uh, according to what
Well,
a good
like what, Dr.
governing
Javadekar?
company should be.
No, I'm glad you brought this
For
up.
example,
No, because I
yeah,
just want to tell our viewers on 10th of March we did a show right here on NDTV Profit on a program called Know Your Company, where we went into detail of Gensol. You can go on our website, you can go on our YouTube channels, where we have threadbare laid out why this was a fishy situation. But having said that,
right.
Dr. Apurva, what are the smoke signs or the red flags that people should have seen and we should have acted on earlier? Because this company is listed since 2019.
Right. So multiple on observable in public domain, it was kind of known from the financial reports of the companies that related party transactions are a big part of the revenues compared to the peers. So related party transactions are always a red flag. In fact, some of the other exchanges like Singapore and Hong Kong make it mandatory to have independent financial audit of specifically for RPTs before IPOs and so on and so forth. So RPT was a flag. Promoters were placing their shares beyond a limit. 70-80% of promoter shares are already placed. Debt was rising very fast. Interest coverage ratio is low. That's all in public domain. So you should have already seen that coming. But from rating agencies' perspective, because I mean, this reminds me of the Wirecard fraud that happened in this. That was a German tech company, a fintech company. Again, there the auditors relied on the self-reported data, and Wirecard was repeatedly saying that we have $1 billion cash sitting in our Asian bank, but no cash was to be found at the end. And again, this was just based upon the self-reported data. Here also, the promoters seem to have forged the letters, like the letters for on behalf of the lenders, PFC, and so on and so forth. But CRAs, the credit rating agencies, could have got a independent confirmation from the lenders themselves. Open banking is out there. You can obviously get information from CIBIL and CRIF Highmark about the defaults. Defaults happened in 30 or like end
So
of
who was
December
supposed to do this?
2024.
No, Dr. Apurva, who was supposed to do this? Because you had
My sense is audit.
Yeah.
Sorry, my sense is auditors in the routine course should get some independent evaluation of some of the balances themselves. They can get it. They have the authorities, and as well as credit rating agencies. So I think both of them and internal audit committees. Most of these related party transactions go through internal audit committees. So that I mean all those. Agencies or the offices had enough powers to do this. The one interesting point I would like to say though is the fraud. The fraud seems to have been perpetrated or implemented through a non-related party, which is Geo Auto. However, SEBI's regulations, LODR, mandates now that if a transaction is with a non-related party, but the ultimate benefit is going to be for a related party of the company, then that transaction ought to be reported. So that is a one violation from that SEBI has highlighted. But yeah, that's sort of interesting point that
No,
how companies are going at length.
Pankaj Tibrewal, you know, this point that if the promoters want to perpetrate a fraud and use public funds as their piggy bank, then where is the watchdog till the ultimate watchdog, which in this case is SEBI, steps in? What were auditors doing? What were independent directors doing? What were credit rating agencies doing? And do you think that there is a larger role than what is apparent right now? Because think of it from an investor's point of view. They think all of these checks and balances are there in the system.
See, Tamanna, on the hindsight, we can ask questions to all of them, right? But the final, uh, responsibility lies with the investors while doing their due diligence. And I believe that in India, getting the right promoters is the most important. We did a masterclass last year, 7, 8 months back, when markets were at their peak with your colleague Neeraj. And the main point was what not to do in investing is most important. And I'm not very sorry for a lot of investors in this case because the writing was on the wall. If you look at the last 5 years cash flow, operating cash, they had not made any operating cash flow. Actually, it was negative. So people were getting carried away by profit growth. But cash finally is the reality. And I always say top line is vanity, bottom line is sanity, finally cash and bank is reality. And hence also every part, auditor, regulator, rating agencies, bankers all have a role to play. But if the intention of the promoter is to do fraud, how can you prevent it?
No, so I don't. Okay, no, so I don't know. I don't know if I entirely agree. If this is the
intention, you can't. You have to do that groundwork. If the
how will a
intention,
retail investor go out and do this
don't
groundwork?
invest. Don't invest directly then into stocks.
Hetal, do you
My
agree?
point has been very, very clear.
Hetal, do you agree? Go to a mutual fund.
If you are not equipped of doing research,
Yeah.
why go into that area and do the stock picking? Many stocks, when they were flying high, people were saying that, what have you done as a professional manager for 20 years? You're only giving 20-25% compounding. Look at my portfolio is flying away to 5x, 6x. Now, the reality is when liquidity comes down, all these skeletons starts to emerge. We have seen cycles after cycles, Tamanna. This is not for the first time. And the point which I am trying to derive is that if the intention of the promoter is to do fraud, whichever checks, balances, everything you do, if the niyat is not right, it will finally reflect the outcome. So we may debate that what were the other agencies doing, what were not doing. But finally, it's the call of the investors that what is the reason they invested in this company? Was cash flow there? Answer is no. Were other corporate governance issues checked out? Whether the promoter's background was checked out on what they have done in the past? Answer is no. So let's not try and, fundamentally question all the other. They are also maybe surprised by the intention which.
So no, okay, that's a point of view. We're having a conversation. We're having all different points of view. Pankaj Tibrewal is saying that अगर चोर चोरी करने ही वाला है तो आप अपना पर्स संभाल के रखो. Net. But then you know who is responsible? Then why should retail investors then have faith in the Indian market? They do if they think that none of the system is working. Let me just get more points of view.
Just a minute, I wanted to make.
Yeah. Okay.
You saw the biggest thing in Satyam in 2000.
Yeah. And no one can say that was not a top-rated company
Absolutely.
at that point.
It was the favorite company owned by so many people, but the intention was to do fraud and show cash as a part of the bank. And that's why we have in forensic called cash yield. In many companies, what we see, the earning on your cash balance is 1 or 1.5%. What does it mean? That if you are earning below your repo rate, that means the cash in the bank is not there. That means at the quarter end, you are showing cash balance because your yield can't be 1.5, your treasury management can't be so bad. So I'm saying that when you have those checks and balances very early on, you can know what to avoid. And in India, to be honest with you, out of the 5,000 listed companies, you need to know where not to invest in. And then your list of where to invest in becomes actually
I'm running out of time. Let me quickly get more views in on this bone of contention. Whose fault is it? Hetal Dalal. If these promoters are in need for fraudulent, as a SEBI interim order says, they can't help it.
Look, I think I'm with Pankaj on a lot of these things, right? My view is that yes, if there is an intent to fraud, it becomes difficult. But I think there is also responsibility from the investors' end. Let's talk about related party transaction. That is clearly a red flag. In most instances, that's something one should question very carefully. Now, when you look at the transactions you brought up in December 2023 or even August 2023, right? All of these are basically providing securities or support to family companies or group companies. The question is why? Now, in this instance, the audit committee failed to answer a question of why should a listed company provide support and financial support to group companies. Two, how many of the retail shareholders really voted on this transaction? Right, these transactions get put to shareholder votes. Retail shareholders only want to make money. They're really not looking responsibly at how the company is operating and whether they can exercise their right and their franchise as a shareholder. So if shareholder democracy is failing,
Yeah, so exercise your right, fair point. Suhail
Yeah.
Nathani, just last point from you. I mean, at the end of the day, at least in terms of equity investors, no one's there to ever bail them out, as it should be. That's not how the system works. But will these promoters now be liable for what they've done, apart from the SEBI rap?
No, I just want to step back. One, I can't disagree. If a promoter wants to commit a fraud, it's very difficult to catch him. But in terms of the market needs to function. There has to be basic trust. You can't assume that, a fraudulent promoter can get away with anything and for the longest period of time. We've had this since time immemorial. The market needs to work and it can't be down to only the investor. Of course, caveat emptor and all that is well known. But what about the systems that were already in place? The point was made by Dr. Jatlikar that where was care? Where did they see when the lending agencies didn't follow the money to actually see that there was a plant up or not? How many cars were bought? The market needs to work for investors to have confidence. It can't be the investor's responsibility to check out everything 100%. Some fundamental issues just come from a solid market. And frauds happen everywhere. Germany, you heard, by fraud, USA, all the places they happen. But we continuously need to improve our systems. And don't forget, this is an SME IPO. You may want to look at how many SME IPOs have had less than
I agree.
IPO.
That's the next question. We need to go back to the drawing board, and something Pankaj Tibrewal talked about, and they've written about that. Watch out for this IPO boom, because there could be a lot of muck hidden under the surface. We're not saying it's everyone and every SME IPO. We're not claiming that. You can't broad brush. That's not the claim. But you need to be careful. And for those who have defrauded the public so blatantly, well, I hope that there is clear comeuppance coming. It's just not enough to have a SEBI interim order. Much more, hopefully, to follow. Thank you to all of you for joining us on the show today. We'll take a very short break, but stay tuned. A lot more coming up on the other side on NDTV Profit.